welcome to Finance Deep Dive. You know, for years we've heard one word over and over again when it comes to the US and China: decoupling. A trade war, a tech race, a big geopolitical standoff. But what if that's not really what's happening? Today, we're going to look past the headlines to uncover something much more complex and, frankly, more critical that's going on just beneath the surface.
So let's ask the big question right up front. Are the world's two biggest economies actually breaking up? Is this the end of globalization as we know it? If you listen to most of the commentary out there, the answer seems to be a pretty clear yes.
I mean, if you just turn on the news or scroll through your feed, the evidence for a total split seems overwhelming, right? We hear constantly about new tariffs, rising political tensions, and this huge push to bring manufacturing back home. It feels like a very straightforward story of two giants just pulling apart.
And check out this number. This really puts that pressure into perspective. By September of 2025, the average U.S. tariff on Chinese goods is expected to hit a staggering 57.6%. Let's be clear, that's not a trade dispute. That's building an economic wall. But here's the thing. That's just the surface story. The real story, the one that's way more complicated and honestly way more important, is hidden. It's buried deep inside the tangled global web of the supply chain. And that's exactly where we're headed.
Okay, so let's first tackle what everyone thinks they know, this idea of a total decoupling. Now, the friction is absolutely real. There's no doubt about that. And it's having a huge impact on businesses trying to operate on the ground. Take a look at this. The U.S.-China Business Council asked American companies what their biggest challenges are for 2025. And guess what's number one? The U.S.-China relationship itself. And look at tariffs. They rocketed up from the 8th biggest worry all the way to the number 2 headache. The result of all this? Almost a third of American companies have actually lost market share in China over the last few years. But, and this is a huge but, here's the paradox. Despite all of that, the head of the council, Sean Stein, says that American companies believe they simply cannot stay competitive on a global scale without being in China. They're totally caught between a rock and a hard place, political pressure on one side and economic necessity on the other.
Okay, now there is one place where this breakup is happening, and it is happening fast. And that's the money. When we look at the actual flow of financial investment, the two economies are speeding away from each other. I mean, just look at these numbers. It is absolutely staggering. Back in 2019, U.S. private equity was pouring $140 billion into China. Fast forward to 2024, that number has basically gone to zero. We're talking less than $1 billion. The money tap has been turned completely off. And you can see what that does to confidence. It's just fallen off a cliff. Business optimism is at a record low. Fewer U.S. companies than ever before are calling China their top priority for investment. So yeah, when it comes to the money, the divorce is very, very real. So you'd think, okay, the investment is gone, tariffs are sky high, that's the end of the story, right? Well, not so fast. This is where things get really interesting. This is where we see the great rearrangement in action. The trade isn't vanishing, folks. It's just finding a new route. So here's the puzzle for you. In 2025, U.S. imports coming straight from China, they were down, way down, almost 30%. But at the exact same time, the number of shipping containers moving around the globe was hitting an all-time high. So what gives? If we're not buying from China, who are we buying from? Where are all these goods coming from?
Well, the answer is these connector countries. It's a clever workaround, really. Instead of China shipping a finished product directly to the US and getting hit with a huge tariff, they do something different. They ship all the parts and components to a place like Vietnam or Mexico. Those parts get assembled, maybe they get repackaged, and then boom, they're shipped to the US as a product of Vietnam, neatly dodging those direct tariffs.
And we are not talking about a small trickle here. The scale of this is just massive. Just look at Vietnam. Between 2018 and 2021, their exports to the U.S. jumped by nearly $53 billion. And you can bet a huge chunk of that growth was this exact kind of rerouted trade. Now, this all sounds like a smart business move, a way to get around the rules. But here's the twist. It's actually created a new, and I would argue, much more dangerous kind of dependency. The whole battleground has shifted from finished goods to the raw materials that everything is built on. Just look at this timeline. It's so clear. As the U.S. put up tariffs, China responded. But not with more tariffs. No, they started putting restrictions on stuff the U.S. absolutely needs. First, it was gallium and germanium for computer chips. then graphite for EV batteries. And then they went for the big one, rare earth elements that are crucial for everything from defense technology to green energy. And this isn't a coincidence. A U.S. government commission put it plainly. China is signaling its readiness to weaponize these choke points. They've realized that their real power isn't in making cheap consumer goods anymore. It's in processing the fundamental building blocks of modern technology. They control the refinery, and that gives them incredible leverage. And this isn't some abstract geopolitical game. This could literally affect the medicine in your bathroom cabinet. The U.S. depends heavily on China for what are called APIs, the active ingredients in countless drugs. That same government report warns that if Beijing decides to cut off that supply, the results for American health could be catastrophic. And it's the same story with pretty much every piece of electronics you own. That phone you're holding, it's built on a printed circuit board, a PCB. And China makes about half of all the PCBs in the entire world. If that supply gets cut off, it could literally shut down huge parts of the U.S. electronics industry. So where does all this leave us? Well, what we're witnessing isn't a clean break. It's not a simple decoupling at all. It's something new. It's the birth of a new kind of interdependence. And frankly, it's a much riskier one. We're calling it rearranged interdependence. Think about it this way. Direct trade in finished goods goes down, right? So we buy fewer things that say made in China. But our indirect reliance on China for the foundational stuff, the processed minerals, the chemical components, that actually goes up. And that creates a whole new set of dangerous vulnerabilities we're just beginning to understand. And this really is the key takeaway. For decades, America relied on China as the factory for the world, the place that assembled everything cheaply. That's changing. Now the dependence has moved upstream. The U.S. is becoming more and more reliant on China as the refinery for the world, the dominant power that processes the raw materials for the entire 21st century economy. So I'll leave you with this question to think about. In this new era of rearranged interdependence, does that made in Vietnam or made in Mexico label on the back of a product even matter that much anymore? Perhaps the most important question is no longer where a product is made, but what and who it's made of. If you enjoyed this breakdown, please don't forget to subscribe to Finance Deep Dive. It honestly makes a huge difference and motivates us to keep making more of these for you. Thanks for watching.